Hello, in this lecture we're going to talk about the double entry accounting system in terms of the balance sheet, which will not be represented as a sheet of paper balancing. Last time we talked about the double entry accounting system with regard to the accounting equation, taking the perspective of the business, the sheet of paper separate from the owner, saying that everything on the left-hand side, assets, is what the company owns. Everything on the right-hand side is who the company owes, either a third party in terms of the bank or a vendor, or the owner. So us, the business, the sheet of paper, the perspective we're looking at, everything that we have on the left-hand side, we owe to somebody on the right-hand side. We're going to represent this same information now in terms of the balance sheet. Important to note that both the accounting equation and the balance sheet represent information as of a specific point in time. For example, if we take our favorite balance sheet account, cash, and we were to ask you how much cash you have on you at this point in time, we could pull the money out of our pockets and say this is how much we have. We might not want to do that, but it's possible for us to do that, as opposed to us asking how much money do you make, where we would have to think about, well, what do you mean, a week? Do you mean a month? Do you mean a year? We usually make that assumption fairly quickly, but we need a time frame for that type of question, an income statement type of question, as opposed to a balance sheet type of a question, which is as of a point in time. In our example, we're going to be using December 31st, the end of the year, as the point in time. We're going to start off with our assets, and what we're going to do is we're going to take those assets and we're going to apply dollar amounts to them so that we can represent the same information in terms of dollars. Cash is going to be easy, of course. Cash, whatever cash is, we have $1,000 worth of cash. But it's important to remember that something like ink, computer supplies, we can't say that we have 4 ink cartridges. That doesn't work for the financial statements. We got to say how much ink cartridgeness do we have in terms of dollars. We need to measure it in dollars. How do we do that? Usually by cost, and when we do the transactions, we'll talk about how we build that up. But for now, let's just apply some numbers saying we basically purchased it for $200. Land, we basically purchased for $40,000. So again, we have $40,000 worth of landness, not so many acres of land. Dollars is our measuring tool. $60,000 for the building of the factory, and $15,000 for the auto. If we then take those numbers, we can put them into a balance sheet. So now we're going to say the asset section of the balance sheet. We can say then we have assets of current assets. Those are going to be more liquid assets. We're going to break the assets up into current assets, long-term assets, liquid assets. More liquid assets include cash, assets that will be more readily usable, as well as the supplies. Those are going to be consumed pretty quickly, more liquid. If we add those up, the 1,000 plus the 200 is the 1,200 total current assets. Long-term assets, we've got property, plant, and equipment, also called depreciable assets sometimes. That includes land. We're going to have that for a longer period of time. That's going to be under property, plant, and equipment. We also have the building or the factory is going to be longer term, and we have the auto is going to be longer term. So the land 40 plus the 60 building plus the auto 15 adds up to total property, plant, and equipment of 115,000. If we add up the current assets, 1,200, plus the 115,000, we get $116,200 worth of assets. Doesn't mean we have 116,200 of cash, but we're measuring the assets we have in terms of dollars. Let's move to liabilities. Do the same thing. We owed the vendor. Let's say we owe the vendor $100 in this case. And let's say we owe the bank, in this case, $70,000 that we took out in terms of a loan. If we put those numbers into the liability section of our balance sheet, we would say that liabilities then, we're going to list liabilities. We're usually going to break those out as well to current liabilities. So those are going to be those that are due within a year. We'll talk more about that later. But we have current liabilities of the 100 to the vendor, and that's going to be total current liabilities of 100. Long-term liabilities, we're saying, is that $70,000 owed to the bank. That's something that's going to be due past a year in the future. And total liabilities then are going to be equal to the 100 plus the 70,000 or the 70,100. Equity section. We're going to say the equity section is what is owed to the owner. So remember, we're thinking of ourselves separate. We're the piece of paper. We're the business. Means we owe the owner, the business owes the owner, $46,100. You can think of that as basically assets minus liabilities, but for right now, we're just thinking of it as what the piece of paper, the business, owes to the owner. So when we look at our balance sheet then, it's as of a specific point in time, the end of the year, December 31st in this case, and we have assets on the left-hand side totaling $116,200 worth of assetness, not cash, but that's how much dollars worth of assets that we have. We owe all that value to somebody, either third-party vendors, which would be the liabilities, that would be the bank and the vendors, and we owe the difference to the owner. That's the $46,100. Therefore, assets equal liabilities plus equity, meaning assets on the left-hand side, the $116,200 of stuff we own, is equivalent to the $70,100 liabilities we owe to third party, plus the $46,100 that we owe to the owner. That's why the double entry accounting system is another format of saying the same thing in terms of the accounting equation, as well as in terms of saying the balance sheet is in balance.